Just a reminder, say, on
Yeah.
meditation, you didn't talk about prayer.
I did. You didn't hear me. Yeah. I did. I said, you know, meditation is a form of prayer, right? So some will say, because some argue meditation is not prayer. Well, but I said it definitely meditation, prayer, right? I would never leave prayer out, and hence I always say meditation, prayer because some may have a different belief, but meditation sounds more spiritual and they don't want to be maybe subscribed to a particular religion. So meditation would make sense to them because it's a time where you are stuck with your own thoughts, you channel them. But for me, meditation can also be a a conversation with God, right? So it's a conversation with God. So it's definitely there, my brother. I'll never leave it out.
Thank
The
you.
audio is fine. I had clicked on the wrong thing earlier. Hey, okay. Where? Okay, okay. Oh yeah, so S&P 500, Nasdaq, Dow Jones, Russell. Do you know what I'm talking about? You've have you heard of these? Have you seen them before?
Yes, sure.
Yes,
Right?
yes.
Because
Yes.
these are quite popular. They've
Heard
become
about them. Mm.
right.
But I don't always, I'm not always sure what they stand for.
Okay,
Index, right?
exactly. These are indices. All right. So these are stocks. Okay, these are baskets, rather, let's put it this way. These are baskets of different stocks, right? So now, whether you're an investor or a trader, when you engage the stock market, you've got two options. You can go for an individual stock, okay, and say, I'm going to buy Coca-Cola, right? But you, of course, need to have solid reasons why you want to buy into Coca-Cola, right? You need to be able to read a balance sheet for starters, right? You need to be able to understand exactly their debtors book, creditors book, what are their measures and acquisitions, etc. Goes on, right? So it becomes a little complex with that particular approach, buying an individual stock. And the risk exposure is greater as well compared to the second option, which is a basket, which is indices, where we say, here's a fruit basket, right? We've got all these different companies. We've got Coca-Cola in there. We've got Pepsi. We've got Microsoft. We've got this one. We've got that one. So we give you a basket. So because it's a basket, it's called indices, right? Now, with these indices, we've got the S&P 500, okay? This tracks the performance of the top 500 US companies. Nasdaq tracks the top 100 companies in the US. Dow Jones tracks the top 30, if I'm not mistaken, top 30 companies in the US. Right?
Okay.
So now, how this question came about, which is trading and investing, is because I was making it apparent to the traders that you should not have an investment portfolio. You're selling yourself short. You're doing a huge injustice to yourself, purely focusing all your energies on trading. You should have an investment portfolio. Your trading is for the short term. You are able to raise capital and pursue your dreams in the immediate term. But investing is for the long run. God forbid something happens to you, right? Not physically only, but I don't know, finances, something happens. You need to be able to cash out of some of these investments. But if you don't have an investment portfolio, then it's a little tricky for you. And it's never too late, by the way. Doesn't matter whether you're 60 or 70. It's no. Because normally when we think of investing, we're thinking, oh, I gotta wait for this thing for 20 years. No, not at all. Not at all. You need to do some research. There are various ways of investing for the medium to short term, and understand that, of course, different countries, different tax implications, understand the implications thereof, right? But when I showed them, it's a pity I'm trying to open on the other side as I'm talking here. I wanted to show you trading view, but it just won't open. So after the session, do yourself a favor, go open S&P 500, right? When you punch it on trading view or your MetaTrader, US 500, that's S&P 500, US 100, that's your Nasdaq, US 30, that's your Dow Jones. You can choose any, right? And just go to higher time frames, and just you will see that over time, this will always these indices will always yield returns, right? So there's less turbulence and stress in having such a portfolio that includes Nasdaq, Dow Jones, and S&P 500, because, well, they just yield returns year on. Okay, let me not say year on year. In fact, no, but I would say I think you can hold me onto that. Can hold me onto that. Year on year, it yields returns, right? So then the question was, but then how? How is that possible? Because I mean, the stock market doesn't quite move that way. Give me a sec. I'm trying to get to what we're all looking at. Okay, because the stock market doesn't move that way. I mean, I've showed you that it moves by a series of higher highs or lower lows. So the market, dips, and it's got its dips. So how can then Dow Jones and S&P 500 over time give you those returns? Yes, it can, because what they do, regulators of these indices, they actually do what we call, which is something that we also do, or I do with my portfolio, is rebalancing. We call it rebalancing, right? So let's say, for example, I have 20 paper assets on my investment portfolio, right? And let's say 3 really underperformed or did badly. So at the end of the financial year, my financial year, when I do my rebalancing, those will fall off and will be replaced by attractive assets that I think have got the potential to yield returns for the next financial year. So with the S&P 500 as well, the Nasdaq, the Dow Jones, they do a rebalancing. So I'm not too sure how often they do this rebalancing and what the exact criteria is, but if there's a company that's performing poorly on that index for a particular period of time, they will be put under review. And then after a particular period of time, they will be removed from the stock market, from that indices. Does that make sense?
Mm.
So basically,
Yes.
so basically then there's your S&P 500, your Dow Jones, and your Nasdaq, always have the best performing stocks, right? And so it's a no-brainer to keep these in your portfolio medium to long term, because, hey, definitely you're definitely going to yield some returns. You're definitely going to, there's going to be a return on investment on them, right? Like, of course, going for one specific stock, right? When that company goes down, well, it goes down, and that's the one that you chose. But if it's a basket, oh well. If you nibble on that grape and it's sour, you can just check it out. There's still other grapes. You get the point. Like if it was just grapes. So you don't only just have grapes, you've got apples, you've got, pawpaw, you've got all these fruits in the basket. I think the point has been made. Right? So that is basically the difference. Now, let's see if we can talk about CPI, which is coming in tomorrow. Let's see if I can switch screens here. While I'm still figuring myself out, what is CPI? What is CPI? Anybody? What is CPI?
CPI basically is Consumer Price Index. It measures basically inflation.
Thank you.
In the economy of America.
Not only in the economy of America, but in all economies, we've got our CPI, which is that measure of inflation. But yes, tomorrow we are looking particularly at the US, right? It's all eyes on the US economy, and for all traders, you need to acknowledge that the US economy is the largest economy in the world. Their currency is a reserve currency. I think I mentioned what a reserve currency is. Maybe not. Did I?
Yes, you mentioned last class.
Right? So
Safe haven currency.
100%, right? So it's a currency that is
JPY, USD, and CHF.
Yeah, by the way, I did give out an assignment. Did we go and check out these economies? What are they made up of? Did we check? Or was the weekend too fun? Too nice?
I checked music.
I did.
Check music.
Okay. Okay. So there was effort put into it. Okay.
Yeah.
Okay. No, thank you. Thank you. Like I always say, it's always and it'll always be in your hands, right? I'm just here to navigate you in the right direction, but the work, it's all on you. And so when you actually do get this thing right, you only have yourself to thank, right? Only have yourself to thank. So yes, CPI is a measure of inflation, consumer price index, right? What is inflation? I think maybe let's talk about that. What is inflation? I know we mentioned it briefly in the first session. Inflation, in basic terms, what is inflation? Here's my calendar in the meantime.
Basically, inflation
Mhm.
is the increase in the price of goods and services in an economy, whereas deflation is a decrease in price.
Yeah, great. Tell me something, is inflation good or bad?
It's bad. Inflation.
It's bad.
Yes.
Quite bad.
Well, if you don't have inflation in your country, that means you're not going anywhere slowly. You're not going anywhere. You're going nowhere slowly. Right? And then if you have disinflation, because you're saying inflation is bad, so if you have disinflation, in other words, prices going down, you're going to be happy at the start, but then you start to see what it actually does to the economy. Because nobody's turning a profit. And if nobody's turning a profit, nobody wants to hire anybody, and nobody's hiring anybody, then things start to close down. not China, Japan has been fighting that for the longest time. So inflation is a double-edged sword. And that's why inflation will always be welcome, but it needs to be controlled. The pace of inflation needs to be regulated, because if it's moving up too fast, it definitely isn't good for anybody, right? So we accept that prices, go up. I still remember how much we used to buy bread and milk for. Our parents used to leave us with 10 rand, and when we get, a sachet of milk and 2 loaves of bread during school holidays. Oh, and we'll buy anyway some sweets as well with the change always, right? So I remember that. Now 10 rand, which is what, less than, it's not even $1. It doesn't get you anything, honestly. You won't even get a single loaf of bread. So it's inflation, but that it has creeped up on us over the years, right? Over the years, right? And it's not unique to only South Africa, but it goes for most countries, with the exception, of course, of Japan, which they have had for the longest time disinflation, that economic wheel not turning. Okay. Now, so yeah, it's a double-edged sword. I think if you own some property, you may welcome inflation, because that means then the value of your assets, hardcore assets, go up. You follow? So we've got tomorrow a measure of inflation, which is very important, coming out of the US. There's a backstory to it, and I don't want to throw you in the deep end. So I won't be going too deep into it, but I have an idea that you have an idea of what inflation is, if that makes sense. So this number, or rather this inflation data, is highly anticipated. This is it here, right? It's red, it's high impact. In other words, it is likely to move the markets, right? There's going to be a lot of market engagement. Consumer price index, month over month, year over year. Now, month over month, 0.2, which was the previous. The prediction is it's going to stay the same. It's going to be stable. Okay. Sorry. Right. And then the year on year, we're currently sitting at 2.9. We expect it to cool to 2.6. Now, like I said, there's a backstory to this. There's context to this. If you do have time after the session, I'm about to close it up anyway. I'm just introducing you to this, and then we are going to go deeper on this. But most economies in the world have got a target on inflation, where they would like their inflation rate to range. Does anybody know? Because pretty much everywhere in the world, we've got a similar inflation target. Do you know what that inflation target is?
No.
No idea? The US one, the European one, the British one, the Swiss one, the Australia's one? No idea. 2%. 2%. Right? It is 2%. So, and I don't know how they, it's basically thumbs up, right? And then somehow all of these reserve banks kind of agreed, 2%, right? Because if you were to ask, why not 3? Nobody really has a concrete answer. But 2% is what all central banks try and keep, or try to target in terms of their inflation rate. In other words, inflation should not rise by more than 2% every year. Okay, so what I would like you to do is go to YouTube, right, and say inflation, right? But I want you to focus more on the US inflation. Okay, everything that you're going to be doing for most of this curriculum, I want us to focus on the US economy because, well, it is the largest economy. Their currency is used for international trade by most countries. And basically, what happens in the US doesn't happen in isolation. It does affect other economies. So it's, you know, when they sneeze, everybody catches flu. So it's extremely important that you keep informed on that economy's developments, if I can put it that way, right? So go and check it out. Go and familiarize yourself. But you know, I don't want to throw you in the deep end yet. We're still doing the ABCs. But for those who are much interested in this data, go and check where that inflation was before the pandemic 2020 and where rather it landed 2 years later after the pandemic, in other words 2020, so you get context and see where they're going, right? Where they're going with their inflation out of the US. So that data is definitely going to move the markets tomorrow. If you are trading a live account, trade with caution, or sit on the sidelines, consolidate your positions, and wait for the data, to come out. Wait for the dust to settle, right? Wait for the dust to settle, and only then will you come in, right? So last week, not last week, earlier when we were looking at that structure, higher highs, higher lows, and I said, we're, as traders, we need to be clear and intentional about what we want to do. We identify the structure, we've got the levels in place, and if we are in a bullish structure, we want to see a violation, of a key level and a correction, right? In other words, role reversal, right? And that's how I played NFP last week, Friday. Now, I think we'll talk about the data tomorrow, just briefly, but I can sum it up for you. So the NFP is basically labor, right? This is labor stats, right? So we got coming out of the US, by the way. So that came out Friday, and I don't know what's going on with most of the people that are on social media, but everybody was up in arms saying that, the data came out not so great. Yes, it wasn't the best, but definitely it was an improvement from last month. Okay. And so I was trading gold. I think the last person I spoke to was Mr. Brian, asking about how I engaged the data. Do you remember, Mr. Brian?
Yes, I remember, sir.
Right. So I took one trade and the rest is history. That was a sell trade, 10,000. Boom, done. One trade. I did not go with the noise that I've just mentioned. I simply went with the data the best way I know how to interpret it, right? And so tomorrow what we'll do is we'll look at exactly what level of interest I was basically interested in, right? So that, because let me leave you with this rather in closing. What happens in the markets today, tomorrow, next week, next month, next year, is not entirely new. It has happened before. So the market is one big song on replay. Let me make my favorite example. Some of you might know it, right? Tell me the name of the artist and maybe even the name of the song. Let's see how quick you can Tell me. I'll try my level best. I'm not a singer. Let me do the beat actually.
Michael Jackson.
Right? Less than 10 seconds. That was less than 5 seconds actually, right? Everybody everybody knows Michael. Is there anybody here who doesn't know Michael Jackson?
No.
Everybody knows Michael Jackson.
Yes.
Even my last born, who's 3 years old, knows Michael Jackson, right? Why? Because, well, he's always in your face. It's TV, it's radio. We remember that guy. He doesn't have to be your favorite artist, but you're gonna find yourself, or you're gonna catch yourself singing along to his songs because we just hear them that often, right? And the new age can remix that song, resample it, do whatever, but you'll be able to say, that's a Michael Jackson song. Even if they take away the beat and just do the lyrics, you will know that's a Michael Jackson song, right? So because you keep on hearing it over and over, you can identify with it. So the same applies with the market. Once you start paying attention and you start going back into time with your technical analysis and fundamental analysis, you start to see a pattern that, oh, hang on. No, so this is not the first time we've had a recession. And when we have a recession, the market behaves this way, right? And so on and so on and so on. It's one big song on replay. Learn the song and you'll be okay. Guys, any questions in closing?
Yes, sir. Yeah, it's regarding CPI tomorrow. My observations how the market behaves on CPI. For example, here we're saying our CPI the previous one, the actual was 2.9%.
Yeah.
And they're expecting the forecast is 2.6%.
100%.
Right? Which is like a decrease.
Yes.
In inflation. Right? So what I've noted is, for example, it goes to 3%, like it has increased from 2.9% to 3%.
Yeah.
What I've noted is they say it's positive for the US dollar.
Yes.
When it decreases like this from 2.9% to 2.6%, they say it's negative for the US dollar.
100%.
But so yeah, so that's how people get confused, because when you say it's positive from 2.9% to 3%, when you say it's positive for the US dollar, what it means is all US dollar based currencies like US dollar to Japanese, it means that the US dollar is gaining power by the increase of inflation from 2.9% to 3%. You see?
100%.
So that's how like it confuses. Like it used to confuse me, but now I know how the market behaves. But the reasoning behind it, you say inflation is 2.9% and the actual comes as 2.6. Inflation has decreased, so they are saying it's negative for the US dollar.
Okay.
Why?
Now I get it. Right? So remember earlier I said it's all about context, right? So under normal market, or rather let's say under normal economic conditions, your inflation rate will always play within the twos, right? Your central bank will always communicate clearly the range that they expect inflation to be in. They might say 2.5 to 3%. That is comfortable, that is normal, that's what they target, right? That's normal conditions. Now we're coming from a place where, and it wasn't only unique for the US economy, but almost all economies with the exception of Japan, where inflation skyrocketed. The US saw inflation highs last seen in the 1970s, right? We're talking double digits, 10%. 10% inflation, last seen in the 1970s. Okay, so when you speak about inflation, you can't speak about inflation and not talk about interest rates. Okay, but without going too deep, the central bank, known as the Fed out of the US, of course, instituted a particular monetary policy. They changed or tweaked that monetary policy in a way that would bring inflation down back to their target of 2%. Now, what happens is whenever inflation doesn't quite, or rather, let's do it this way. Where's my pen? Right? So it goes all the way up. This is 2020. Let's say this was 2019. Shoots up. 2021, 2022. They start to change their monetary policy. It comes down. And we know where we want it. We want it at 2%, right? But then, like you say, it's at 2.9 right now. If it comes out at 3, in other words, it's going up and not going down. If it comes out at 3, they say it's positive, and so the dollar buys. Yes, it's a positive number in terms of, moving from 2.9 to 3, but it's not something to be celebrated and say, "Ooh, it's going up." No, because we know what the target is. It's meant to be 2%. So then why are we buying the dollar instead of selling it, which would be a proper reflection of our disappointment? Is that what you're saying? Why are we not selling it to show our disappointment?
Yes.
But in other words, but instead we are buying it. No, we are buying because the market, as investors and as retail traders, or just traders in general, we are forward looking. We tend to price in possibilities, right? So what I'm saying is, because the data then moves higher, inflation shows that it's moving higher. What does that tell us? What can we anticipate coming out of the central bank? What decision are they likely going to take? In this instance, we now anticipate that interest rates will go higher, and higher interest rates equate to an appreciation in that currency. And that's why. But if it goes down, we sell in anticipation that the interest rates would go down, because lower interest rates devalue the value of the currency. Hey, let's leave it here. Okay? Let's leave it here.
Yeah, no, I will engage you on your inbox. I'll engage you.
Engage. I don't want to go too deep, and then others are thinking, now, you see, now what are we talking about now? Right? It's
All right.
yeah.
All
But
right.
for those who have an idea of what I'm talking about, or want to go a little deeper, maybe overnight. Like I said, you can't talk about interest rates without talking about inflation, or inflation without talking about interest rates, right? So maybe you start researching, how do interest rates affect inflation, or how do yeah, I think that's the starting point. How do interest rates affect the economy? In fact, let's make it broader. How do interest rates affect the economy? Not just interest rates, not just the inflation. How do interest rates affect the economy? Ladies and gents, any other question in closing? Are we all good? Okay.
Thank you, Lady. Thank you.
Thank you very much.
Thank
Trust
you.
you had a fantastic session and
Thank you.
too draining,
Yes,
right? Thank you very much,
Thank
guys.
you so much. Thank you so much, sir, for
Shaya,
taking your time.
Shaya. See you tomorrow, same time, same place.
Okay, bye.